What's up, duly diligent investors? Today we're going to be talking about yet another high-yielding ETF. In my other video, we talked about SPYI, which seemed to be a crowd favorite with its stable NAV and high dividend yield. Now let's talk about its little brother, QQQI. QQQI stands for the NEOS Nasdaq 100 High Income ETF. It's a dividend-focused ETF that currently yields a whopping 14% while capturing some of the upside of big tech. AI everywhere. QQQ is based on the NQ, which is based on tech. The NQ, or Nasdaq Index, is generally known for its composure of the 100 biggest tech companies in the US. Tech has been the industry with the highest return since the inception of the stock market. So what if you made a fund that's based on tech for a solid foundational underlying, plus it also pays a sweet dividend? That's what QQQI is, running the same covered call strategy to maximize income generation at the cost of capping your upside. You know the top tech companies in the US, right? Ones that just seem to appreciate exponentially. It makes you wish you YOLO'd in at Microsoft at $2. You know, the Mag 7. This fund's core holdings are those companies. The principal objective of QQQI is to capture some of those market gains while also shelling out a monster return distributed monthly. You can pay your rent, your car, your phone, your Chipotle with double protein, and a bag of chips with guacamole, and an organic lemonade. So should you invest in QQI? Is it better than SPYI? Or why not invest in both? Let's dive in and find out if it's a worthy investment of your precious hard-earned bands, or if it's just a yield trap, like in NEOS's prior disaster, NUSI. So first, let's dive into what is QQQI. As we mentioned earlier, it's a dividend-focused ETF, meaning income generation is the priority. Notice that these ETFs will never capture the same upside as its underlying one-to-one. It's currently managed by NEOS Investments, the same guys behind its big brother SPYI. The principle is the same. They're at covered calls, underlying hoping they expire out of the money, except they do it on the Qs. The prospectus clearly states that the fund's principal objective is to generate dividends by using a covered call option strategy. This lets them sell premium while capturing some of the upside. Something else to note is that the fund is actively managed while also being tax efficient. They utilize index options that are 1256 contracts, so they're taxed favorably at 60-40 tax rates rather than 100% short-term gains. This means when it's time to pay the tax man in April, dividend payouts from QQQI are taxed at a lesser percentage than other funds that don't utilize index options. 60% of your gains are taxed as long-term gains, or only 40% are taxed as short-term gains. It may not sound like much, but it really adds up. But don't worry too much. Just know that's more tax favorable compared to many other firms that run their strats on tickers like SPYI or QQQ. Now, you already know it's designed to generate that high monthly income by investing in the constituents of the Nasdaq 100 index and implementing a data-driven call option strategy. Sound fancy? Not really. Let's break it down. I would also like to thank today's sponsor, no one. How does QQQI generate income? It's simple. It invests in the stocks of the Nasdaq 100 index and uses a call option strategy. This is the third time I've said that. By selling call options, it collects the premiums from those sold calls, hoping that expire out of the money so it can capture 100% of the premium. This provides a steady stream of income, assuming that NDX doesn't move too much. If it suddenly spikes up in price, NEOS will have to buy back their calls at a loss or roll them up and out. Most of the dividend is funded by the call option. This fund will also buy long calls in addition to the sold calls to generate a net credit, which is the difference between the premium received from the fund from selling the calls and the cost of buying out of the money. In other words, it's a vertical. And you can see their positions updated on their site every single day. The main cash cow is the written calls. They state that they must invest all of the investor capital, i.e. your money, into writing these call options, but they may also buy out of the money calls to provide some upside capital appreciation for NDX, assuming it keeps going up. NDX is considered well diversified. It is a huge index and it's made up of the 100 largest companies on the Nasdaq exchange, excluding the financial sector. Let's take a look at the dividend history. Over the past trailing 12 months, QQQI has paid out a total of $7.32 per share in dividends, which translates to a roughly 14.25% yield based on its current price. The lowest dividend paid out was 53 cents, which was paid out in April, and the highest was 64 cents, which was paid out August of last year. It's paid out 13 consecutive monthly dividends. That includes consistent payouts each month without interruption. Note that QQQ is considered a more volatile index than SPYI, so you can expect more dividend fluctuation. QQQI does pay every single month, which is pretty awesome if you love regular income. For a $50 stock, 14.25% yield, that's nothing to scoff at. Don't forget that the average return of the entire stock market is around 12% per year. The average return of real estate is around 10 to 12%. The average return of your bank account is 0.1% per year. Now let's talk about the overall performance of QQQI. Since inception on January 30th of last year, QQQI has delivered a total return of about 20%. It includes the monthly dividend distribution, which is about 62 cents per share, plus it gained about 5% in price appreciation. That's not bad. Most of these high yield cover call funds either have significant NAV erosion or they just don't deliver these kind of yields. QQQI seems to be doing well, but then again, it's relatively young. Its strong performance is tied to the Nasdaq 100 stocks and the overall market rallying like crazy this year. Because of the sharp increase in the underlying, you can bet that some call spreads may have been breached. Even though we had that nasty pullback in April of this year, QQQI maintained its payout on a percentage basis, showing its resilience in these volatile conditions. For a high-yielding ETF that deals with covered calls, this is actually pretty impressive. Maybe they learned their lesson from NUSI. Okay, but how does QQQI compare to SPYI, or JEPQ, or Q yield, or QQQM? Remember that this fund's goal is to generate income. Capturing upside secondary. If you want upside, you have to give up some yield. If you want yield, you have to give up some upside. If you're more focused on price appreciation with a dab of dividends, look into something like SCHD or VIG. Like any other high dividend fund, QQQI is no exception. With great yield comes great responsibility. The trick is to find out what suits your time horizon plus your risk appetite. This fund is considered medium risk in my opinion because of its underlying NDX, which moves like crazy. Current market conditions, we have tariffs, economic woes, geopolitical tensions, AI bubbles, etc. There's a lot of uncertainty. NDX is considered to be much more volatile than SPX, so it reacts and moves a lot more violently when something happens. This means it has a lot more fluctuation, which is quite devastating to call options. If the written options are breached, NEO's investments will have to buy to close or loss, roll their positions, or cover their shares and then recycle them to start over. If they want to keep pumping out those divs, they have to do something. While QQI doesn't capture the full upside direction, it does capture the full downside risk 1-to-1, and then some. If there's a major correction or we enter a bear market, or even a black swan event, NDX will tank and so will QQQI. Remember, there are no protective puts in place, so it'll just tank like the underlying. The premiums garnered from selling call options may offset some of the losses, but it's likely not enough. The fund may also not be able to sell the declining securities while the options are in play. Capping your upside on tech will very likely limit your overall performance compared to simply investing in the underlying. If you only care about getting paid no matter what the market is doing, then QQQI should fill your piggy bank. It should provide you that reliable monthly income whether the market is bearish or bullish, so you can continue to pay for your 12 different monthly subscription services. So basically, you take on all the downside risk, we're only getting a fraction of the upside. This is also why cover call ETFs take so long to climb back up after a drawdown compared to holding the underlying directly. If NDX or QQQ were to drop 20%, then cover 10%, QQQI may only 0.25% recovered. QQQI will be lagging way behind since their calls will constantly get tested at the tail end of a bear market when we enter an explosive bullish market. The next biggest risk is NAV erosion. NAV erosion is definitely something you want to pay attention to. NAV, or net asset value, represents the per share value of the fund's assets minus its liabilities, basically the stock price. QQQI's NAV has eroded a little bit over time, but so far the dividends have made up for it, so you're net green. As long as the dividend payouts offset the NAV erosion, you'll come up on top. I've yet to see a high yielding cover call ETF with the positive NAV over an extended period of time. Remember, there's no such thing as a free lunch in the market. Whether or not the overall percent gain from the dividends minus the NAV erosion is worth it or not is up to you, but it comes at the cost of the NAV price. Basically, the principal is eroding to maintain such a high yield. You're losing your initial principal investment, but you're getting paid back a monthly paycheck. If the annual yield is more than the NAV decline, then you should be profitable. High dividend payouts can reduce the principal value of your investment over time. It's extremely difficult to sustain something that yields higher than market returns while maintaining an upwards NAV. Ideally, you want something that yields 13 or more, so at least you're slightly matching or beating the market, or else you'll make more money just buying and holding SPY. But we don't care about that, right? We only want those monthly paychecks. We're yield chasers. Who else is going to pay for my Walmart Plus subscription? Man, my jokes are terrible. So what are the good and bad markets for QQQI? The real benefit of this fund is during economic downturns, you generally still get paid. If the fund is consistent, reliable, and has a decent underlying, it can continue to churn out dividends even in bear markets. Many people compare dividend to buy and hold. Buy and hold will generally outperform dividend funds and give you a higher overall return. Whether you want to put your money into buy and hold or dividend funds depends on what your goals are. Investing in buy and hold means you have to sell your shares to get a payout. If there's an economic downturn, you may be flat or even negative. Dividends can help by continuing to milk out dividends even though the underlying is down, so you can continue to get paid without having to give up the shares. The market eventually corrects, assuming the NAV recovers. This is where those funds shine. You got paid to basically sit through a bear market. Your principal is intact. You didn't have to sell your shares at a loss, so you still made money even though the underlying lost money. So it's basically free money, right? So should you invest in QQQI? As we mentioned many times already, like a broken record, it's built for dividend investors. Even though it has some capital appreciation built into the fund, it doesn't make sense to invest in it for that reason. It's second to income generation. Put your money in a buy and hold if you want capital gains like QQQ. It'll compound much more quickly than a cover called drag on it. But if you don't care about the price appreciation, you just want income so you can get that sweet divvy every single month to cover some bills, or QQQI may be a suitable perk to park your cash. The key thing to keep in mind is that you need to protect your principal. The yield must offset the NAV erosion and be enough to give you an ROI to make it worth it. QQQI is good for people who love high dividends. That's the main point of putting your money into this fund, and it definitely beats your FDIC insured bank account. Monthly income. If you want to cover your monthly Netflix, phone bill, or even your car payment, having dependable income every single month feels good, man. Some people will argue that monthly or quarter payouts don't matter, but having money flowing every 30 days makes it feel more like a paycheck. It's easier to finance for daily expenses. Reliable income. The payouts have been consistent and have not missed a payout to date. Exposure to the NDX. Nasdaq 100 index is on par with the SPX. They are the definitive buy and hold funds, so they're designed to go up, bigly over time. As long as NEOS manages QQQI by buying those long calls, you'll get some upside movement. Its underlying is also solid. If it crashes, lose all your principal, you probably have bigger problems to worry about. Active management. QQQI is actively managed by NEOS so they can constantly manage their positions. You can see what calls they're in, what calls they wrote, what other verticals they're putting on, and where your investor capital is pooled on their site. Of course, this is why you pay an expense fee and what motivates them to continue squeezing out those sweet divs. Moderate risk. If you have a moderate risk tolerance, QQQI may be suitable for your risk appetite. It complements buy and hold. If you have a boring buy and hold fund that's just not giving you the excitement of those payouts, QQQI may be a good complement. You can get income while getting capital appreciation. Then you can utilize your cash now if you want to reap the rewards of investing and keep you motivated to continue investing and doing your DD. So that's a wrap on QQQI. Overall, this fund is very similar to SPYI. The only difference is the underlying, but the overall strategy is the same. The fund has minimal erosion so far and continues to put an impressive dividend yield. NDX is safe as long as big tech continues to perform in the long run. But you can expect some bumps along the way, especially in this market environment. I will keep watching QQQI over time and see how the NAV reacts, especially after this big dip that we had for the past couple weeks. However, it seems to be recovering quite well. I'll consider putting some funds into it after tariff pause is over to see how the market reacts. If you like these dumb videos, go ahead and subscribe and like this video and hit the ding and all those things. Let me know your thoughts on QQQI by leaving a comment. Do you think it's worth investing in? Let me know your thoughts. Till next time, keep doing your DD, keep investing, and keep getting paid. Degen out.